The following program is paid for by the Real Estate Radio Network.
You're listening to Real Estate Radio Fresno on 105.9 the FM KMJ. Now, live in studio, your host, local real estate expert, Craig Barton.
Good morning, Central Valley. I'm your host, Craig Barton, and welcome to the Real Estate Radio Network, the most important hour of radio each week, here on 105.9 the FM KMJ. Real Estate Radio is a show dedicated to bringing some rational thought to the crazy world that we live in and helping you to rebuild the Central Valley's housing and credit markets. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice, and that's exactly what you're going to hear every Sunday morning from 7 to 8 a.m. right here on 105.9 the FM KMJ. Thanks so much for joining us. Well, good morning, ladies.
Good morning, Charlie.
I was waiting for that one.
Sorry. I can't help it. We sound so good together, like the angels.
You guys do. So
we are your little angels.
Somebody's a soprano and somebody's a baritone, right? Oh, that was a curveball.
Yeah, whoa.
Hey, we're dumb but not stupid.
It's like asking somebody's natural hair color.
Yeah.
You just
don't do that. Okay.
It's the muted color of black.
Right.
Just don't call any of us a baritone, right? Is that what you're trying to say?
Exactly.
Okay. Gotcha. Well, those perky voices in the studio with us are our special guest host, Michelle Pettiscavalli.
Good morning.
Good morning, Michelle. Thank you so much for being with us. Michelle is a licensed realtor and a trusted friend.
Thanks, Craig.
Awesome. And we also have Miss Kate Eiland from UBS Financial Services, our local financial expert here in the studio with us. Thanks for getting up, Kate.
Absolutely. Good
Every time you say
to be here.
Huh?
Every time you say her name,
yeah,
I want to be on vacation somewhere. Kate Eiland. Kate, please take me to your island.
Right.
Wow. You better clear that
I am
with
an island unto myself. I'm always on vacation. My life is great.
Wow. All right. Well, ladies, thank you so much for being here this morning.
Absolutely.
Providing this hour diversion to your island.
Right.
Well, the Real Estate Radio Network gives us the opportunity to reach so many people efficiently for one full hour each and every week. Our goal, our collective goal here at the Real Estate Radio Network, is to get you, our listeners, the timely and accurate truth about your local real estate market so we can help bring you
Back home.
Well said.
I like that.
Well, thanks.
Well
That's
said.
nice.
Well, I am extremely excited. Okay, don't bask in the
He doesn't know
limelight too
how.
long, guys.
sorry.
He doesn't know how good he has it.
All right,
Hold on, wait.
down, girls.
I'm done congratulating myself now. Okay.
Are you over it? My gosh.
guess.
I'm super excited about today's show. We're going to take a look at some of the top stories in the news, and there really is it seems like lately there is no lack of stories or at least topic content to cover.
Right.
We're also going to have Kate Eiland with UBS Financial Services here in the studio with us to talk about bonds as well as our Market Watch update. And short sales. Are you tired of hearing about short sales? Well, I tell you what, we're still going to continue talking about it because it's extremely relevant. Well, we're not out of the woods yet. And with the uncertainty of debt forgiveness legislation and the real estate market heating up, we're going to take a closer look of if now is a really, truly good time to short sale your home. We're also going to take some listener questions.
I love them. I do.
Make sure you stay with us. Again, if you have any real estate or mortgage-related questions or questions regarding the information that you hear on our show, call us anytime at 800-979-3958. We'd love to hear from you. You can also check out our resources online and go to our website, as well as listen to past shows from the Real Estate Radio Network on YouTube by going to our website at reofresnohomes.com. To friend us on Facebook, use press for keywords.
Friend Valley-wide on Facebook.
A little bit of a pause there.
I'm
huh?
sorry.
Okay.
I'm doing
Johnny,
five
you can
things
edit
at
that out,
once.
right, buddy? Thanks. Or use press for.
It's a dramatic pause.
Yeah,
That's right. It was.
Building the anticipation.
Exactly. Well, you had everybody, all 11 million of our listeners.
Hey.
Oh, cat's got Michelle's tongue, right?
Never
Or
happened.
use press for keyword
KMJ, call Valley-wide.
to get connected to us anytime. We'd love to hear from you. Well, you heard us talk about Press 4. Again, we're going to continue to talk about Press 4 every single week. Press 4 is our most efficient way, when you're not in front of the computer, to help us push information that's important to you right to your smartphone. All you need to do is go to the Press 4 website. That's PRESS, the number 4.com. Follow the easy setup instructions or go to the App Store and download the Press 4 app. Sign up. Next thing you know, it is a free service, I must say. Next thing you know, you'll be using Press 4 and you'll help us to push real good info directly to your smartphone. It's for all those times when you're not in front of a computer. Pretty good.
Makes it easy.
Yeah, well, let's talk about today's hot properties. Well, today's hot properties are brought to you by Perfect Home Inspections. Residential, multifamily, or commercial. Call Jerry Schooley today for your perfect home inspection at 352-6941. Again, that's 352-6941. Michelle, let's talk about your hot property today.
My hot property is a 2.5-acre parcel at 2371 North Hayes.
That's a big piece of property.
It is a big, beautiful piece of property with a pool as well as a home, 3-bedroom, 2-bath. Additionally, it has a mobile on the property that has been there for quite some time that they rent out, which is a nice feature. So if somebody's looking for a mother-in-law suite or has kids that are getting kind of
maybe
college age,
income.
or rental, it's actually a great property for that. We are going to be there 1 to 4 today. Additionally, if you have an agent and you'd like to talk with him, please have him give me a call and we can set something up for a different time frame if necessary. But it is a great property.
You can also see this hot property on our website, as all the hot properties. You can see that on our website at Fresnohomes.com. Really, really important. That is real-time and accurate, up-to-date status as far as that listing is concerned. Our second hot property today is 5958 East Via Marilago Drive, Fresno, California, 93727. This property is located in Sunnyside. It's a 3-bedroom, 2-bath, 1,668 square foot home built in 2009. It's barely new. Located in a gated community in Sunnyside, Sanger Unified School District. All this for only $163,000, which is, by chance, also the FHA appraised value on the property. The bidding deadline is daily at 11:59 Central Standard Time. It is eligible for FHA financing. Save your buyer the cost of an FHA appraisal. And if you submit an offer today, you'll know by tomorrow morning, Monday morning, by typically 11 a.m.
Wow. So it happens overnight?
It happens overnight. It's a super, super efficient process with HUD. Yeah. So if you'd like more information about today's hot properties, please give us a call anytime at 800-979-3958 or use Press 4 keyword
KMJ Hot Property.
And we'll send more information about these hot properties right to your phone. Look for more hot properties each week here on the Real Estate Radio Network. Let's talk about top stories in the news. Now, this may not be as good in our listeners' eyes as you didn't build that.
Yeah, that was profound.
Yeah, I tell you what. And the first one, Kate, this is right up your alley.
Oh, good.
This is really right up your alley. The effects of oil prices or gas prices on commodities that we buy today. And I tell you, I keep hearing it in the news. I keep hearing it at the gym. I keep hearing it from people that obviously that use a lot of gas to get from here to there, or they're trucking produce from here to there, and they're saying, hey, we're already looking down the road and trying to price in these increases that that have already come, as well as the ones that are coming.
Right.
So it hits the consumers, so it's already hitting the consumer's wallet as we speak. So talk a little bit about the economic outlook and what you're seeing, as well as what you're hearing as far as gas prices, because they have gone up as of late.
Yeah, well, and there's a difference between oil and natural gas. I mean, oil is typically right now what we use to fill up our cars, and that, the price was considerably higher a couple months ago, and we saw a real steep decline. There is actually speculation that we could see a further dip in oil prices because of the glut of supply in natural gas that we have found, but also because we found a lot of oil here locally, as we talked about last show.
Right.
So, that being said, that there could be some near-term dips, but looking at future consumption, global demand, oil is not a U.S.-based commodity. Commodities are globally based.
Right.
So it's not just what we're consuming here; it's what other countries are consuming. And for instance, like if you think of coal, we actually produce a lot of coal here and ship it to China. They use a lot. I think they are actually the number one user of coal in the world. But the price of getting that coal over there can directly be affected by the inputs that go into that. So if they're shipping it, what are the tankers using?
Sure.
You know, so it can have a direct effect on all commodities. And that, no doubt, I mean, oil prices are not considered in the core inflation number that the government reports. And my business partner and I always have such a big problem with that, because from a retail standpoint, you know, it's food and it's gas inflation, and if those things are going up, they can, you know, creep into core inflation. But also, it's a direct effect on your pocketbook.
Right.
There's no doubt about it.
No, in every way, shape,
so it's
form.
something you definitely have to consider. You know, thankfully, the price of natural gas right now is relatively low. We just don't, as we talked last time, don't quite have the infrastructure yet in place to be using it en masse. But you know, hopefully, shortly within the next couple of years, we will. But it's definitely something to pay attention to, the price of oil.
So let's take this conversation a step further. Let's add an additional layer here with the drought conditions that we've seen in the Midwest. And as Michelle said, we're such a corn-based consumer because...
Oh, no. Yeah.
Give the example.
I did a little bit of research, not a lot of research, but toothpaste. They use corn to produce toothpaste. I mean, that's how, like, a wide variety that we use corn for. I mean, we feed animals with it, but we feed people with it, but the corn syrup, I mean, everything you can imagine has some kind of corn base in it.
It's huge,
for starch or whatever they're creating.
And we're the number one producer of corn. This drought has had major effects, not to mention other weather-related issues like flooding. For instance, Australia had some really bad floods. But right now, I just read something that Thailand is actually stockpiling rice because their wheat and corn inventories are down so incredibly low, so they're doing something so that people don't starve. Well, here it's not as big of an issue
as other places.
In the U.S., our food budget is around 10 to 12% of our total expenditures as consumers.
As consumers,
okay? Some countries, like for instance Egypt, they spend 40% of their budget on food. So when the price of corn or when the price of wheat, for instance, there is a big issue, when that doubles in price, think about that. What that would do to your family's financial immediately.
80% now.
Exactly.
Wow.
And why do you think there's riots?
Right.
I mean, the issue of food. You caught me at a
We're so blessed.
Because,
we're so blessed.
Absolutely.
Here. We don't realize.
We really don't realize what an issue it is in poorer countries. But the issue of food is going to be radical. I don't know if it's going to be, 5 years, 10 years, 20 years, maybe it's even longer than that, but at some point in time, I certainly think in my lifetime, I'm going to see a time where food rationing becomes a major item. I mean, you literally just caught me. I just read a huge report about it.
Really?
It's so fascinating and very scary. So these times when you have these weather-related issues, and we've had 3 years of back-to-back of weather anomalies, like and really the probability of having 3 years like that in a row, it's like 1 in a million, and we've had them all happen, and then other things are happening in different countries that are really crimping our food supply.
And to make things worse, Congress, in their most recent ag bill that they had passed, they did a little accounting trick and left out a certain portion of aid that was supposed to go to farmers that had cattle and so forth, and to make the bill look good and to get it through. Well, it just so happens now the pig farmers and the cattle farmers are needing aid, and they were pushing before Congress left to go on their break to get something done because this was emergency. And
it is. If you think the inputs into cattle, what is it? It's corn.
Right.
Corn and wheat, and those prices have gone up. Well, and another thing too, related to beef, it takes 30 pounds of like corn and wheat, some mixture of that, to produce really 1 pound of beef.
Wow.
And for instance, in China, where their middle class population, so more of their country is moving up the socioeconomic scale, and so it's a kind of a funny thing, but as people get richer, they eat more meat. And so then the strain on the corn and wheat supply is even greater because you have a very large population that is making more money and they are consuming more beef, and it's just more draw on the supply. And we already are having issues because of the drought.
Now, and I don't know if corn is like a lot of the crops we have around here, but so many crops are sold ahead of time before the season even begins, and there's speculation on what it's going to cost to transport it, grow it, etc. So So, I mean, that's where gas is affecting that as well.
Yeah.
So.
Well, and it can benefit, commodities trading is a huge issue, and it originally started as farmers, it's insurance. If you can lock in a price, say, I'm going to sell this for X at 3 months in the future, if the price goes down, you still get to sell it for X, but if the price goes up, you still have to sell it for X.
And you lose.
Any of but some of these big farming operations who have hedged their bets with commodities, if they have to sell it at these lower prices that they didn't see this drought coming, it could be an issue.
Sure.
Another thing is too about that the crops that were planted that are actually being reaped now were planted back in 2008. So it takes a long time for these crops to actually grow. And if this crop is ruined, I mean, think about the supply then for the next couple of years. It's a big issue, no doubt about it. It's been a big topic of conversation amongst our clients, and it's just recently come up because of the droughts. But I think even if the droughts hadn't have happened, I think it's a major issue from a worldwide perspective. So.
Very interesting.
Yeah.
Second thing, mortgage rates rise slightly last week. Kate, any input on that?
Market rally.
Yeah.
Less pressure on bonds.
You got that right.
Yeah, I mean, that's basically it. Market goes up, so people feel a little more comfortable. They pull money out of bonds. So what happens to the price of bonds? They go down, the yields go up.
Rates go up.
Wow.
Yeah. We'll see. We think at the end of August, when the Feds meet again in Jackson Hole, that they might do another round of easing. And what they would do is buy mortgages. They buy mortgage-backed securities. So it's possible you could see those rates come down. But we've said on the show so many times, how much lower can rates get?
Yeah, exactly.
Really?
You're below 4% easily. And in some instances, below 3%. If you're talking 15-year term.
Depending on the term of the financing. Yeah, but the Feds might do something else with this easing. They might actually reduce the discount, the rate at the discount window, which is the rate that they on loans that they actually lend to banks, and I think that's more aimed towards spurring bank lending. If you give them cheaper money, maybe they'll be more apt to lend it out.
Okay,
we'll see. Yeah, I don't think.
No, come on.
I kind of doubt that.
You guys tried that one on me before, and you know what? I fell for it.
I'm just saying.
I fell for it the first time. I'm not falling for that one again.
Speculation is.
Yeah, they called that TARP. Yeah. And,
no. That wasn't cheap money. TARP was free money.
Yeah. Oh, I'm sorry. Yeah.
Our mistake.
Yeah.
My bad.
Well,
But
still, a little different.
Still, at 2%.
I'm not saying
2.5%.
I'm not saying
it's almost
I agree
free
with it. I'm just saying that's a possibility because.
But it's almost free now, for heaven's sake.
I know.
Last thing's top story in the news before we move on. Feel good story. Oscar Pistorius.
We're like, woohoo!
Yeah. The Olympics. Has anyone seen anything regarding Oscar Pistorius? And
I haven't actually. And I've been watching the Olympics.
They call him Blade Runner. He is a young boy that was born with malformed legs. He's a man now.
He's a man now.
He was born with malformed legs, and he had to have his legs amputated just above the knee.
It was running on the spring.
Yeah.
I don't know what they call them, but yeah. Didn't he do well? I actually didn't see that race.
Well.
But I read some headline. I think about it.
He withdrew just recently from. Oh my gosh. He withdrew from the 400, I think it was. He is going to be, because he was actually competing in the Olympic Games, he's going to be competing in the Paralympic Games, which he is the record holder in the 100, the 200, and I believe the 400. Now it seems like there's a little controversy that's stirring about that they think he has an advantage as far as those springs are concerned. And
are you
and they said
me?
this, I kid you not, they said this the other night, and he says, okay, these springs have been around forever. And I'm running these times with something that everyone else has had access to. And now it's an issue. Because he's experiencing a tremendous amount of success. I'm just going to say this. This particular gentleman was born without legs. His resolve and his demeanor is like no other.
We could all use a little bit of that.
We could all use a little, excuse my slap on the behind and a wake-up call that the only limitations that we set on ourselves, you wake up in the morning and you feel sorry. You feel tired. You feel like, God hasn't smiled on you that day. Well, I'm just going to tell you this. You read a story about a runner like this, born with what God gave him.
Yeah.
And he has turned that glass full or half full into something way, way better. So
like a river now.
Shake it off.
Yeah.
Seriously, shake it off, and it's all about your attitude that determines your altitude.
Seriously.
I mean, really, when it comes right down
I wake
to
up
it.
with a headache and the day's over. It's like I can't even imagine. I mean, seriously.
And here we are talking about
that man must have.
Yeah, we're talking about people with no legs and no corn here, Kate.
Right, yeah.
We're blessed.
We are blessed.
And not able to fill up their gas tank.
That's right.
Exactly.
Well, again, if you have any real estate or mortgage-related questions or questions regarding the information that you hear on our show, call us anytime at 800-979-3958. We'd love to hear from you. You can also check out our resources online. You can listen to past shows from the Real Estate Radio Network on YouTube by going to our website at reofresnohomes.com. To friend us on Facebook, use press 4 keywords.
Friend Valley White on Facebook.
Or use press 4 keyword.
KMJ, call Valley White.
To get connected to us anytime. We'd love to hear from you. Well, coming up, we have Kate Eiland from UBS Financial Services, our local financial expert, with our Market Watch update. Make sure you stay with us. You are listening to the Real Estate Radio Network here on 105.9, the FM KMJ.
This program is brought to you by the Real Estate Radio Network. Visit realestateradio.us for more info. That's realestateradio.us.
Thinking about buying a home? Find out how the HUD Home Store can help you. Visit HUDHomestore.com. Look at HUD homes available for sale near you or nationwide. Why HUD Home Store? HUD will pay up to 3% of the buyer's closing cost. The price of the home is based on an FHA as-is appraisal, which is already completed, saving you an average of $400. And there is an owner-occupant priority bidding period during the first 30 days. Want to know more? Visit HUDHomestore.com.
Mortgage interest rates are at historic lows, and there's never been a more affordable time to buy real estate. Whether you're looking for your first home, moving up, or your next income-producing property, let the mortgage professionals at Valley White help. Valley White Homes has been helping homeowners with their mortgage needs since 1997. When it comes to the Valley's real estate, we know our way around the neighborhood. Call toll-free, 800-979-3958, and put the seasoned professionals at Valley White Homes to work for you. Valley White Homes, NMLS number 342062, 235-952, California Department of Real Estate License 0122-8460.
You're listening to Real Estate Radio Network with local expert Craig Barton. Now, here's Craig.
Well, before the break, we were talking about bonds, mortgage rates. We've got Kate Eiland from UBS Financial Services, our local financial expert here in the studio with us. And Kate, you're going to make us smart today.
This is my favorite topic. Can I tell you that I love bonds? I know that a lot of advisors, it's like, people think that stocks are sexy. Bonds are sexy. Let me tell you this right now.
Wow.
And no, but they're actually very interesting, and they are what makes the world go round. So it's very important that you understand what they are.
And it's an important part of when we talk about not putting all your eggs in one basket.
Absolutely.
And portfolio diversification.
Right.
It is a must. It is an absolute must to ensure. Exactly.
Yeah,
you have
absolutely. Balance out your returns.
So when you say
income.
They make the world go round, give us just an overview. What is a bond?
So a bond is nothing more than a loan.
Bond. James Bond.
James Bond.
Oh, sorry.
No, it's just a loan. And different types of bonds, different names. Like, for instance, municipal bonds are loans to municipalities. A municipality can be a city, a state. It can be to build an airport. I mean, that kind of thing. So that's a municipal bond.
So are they specific to when you buy a bond? Is it a bond for, like we talked a few weeks ago about Stockton? When you buy a bond, a municipal bond, is it specific to a county? I mean, is it set up in that capacity?
Yeah, and we'll get into like how exactly you buy bonds, because you can buy them individually, and in that case, if you buy a municipal bond, you will seek out a certain issue. If you say, I want to loan the state of California money. That would be a municipal bond.
What you just said right there, Kate, that's really huge, because that really does break it down. I want to loan the state of California money, and there is a bond that you can purchase specific to that.
To that, yeah.
Yep.
And I think you have to think of it like that. The last couple of years, we've been telling our clients this for a while, but I think people have been lulled into thinking that bonds are supposed to have all this growth in them. After 2008, the bottom dropped out of the bond market. Prices went way down. And so if you owned bonds since then, you had double-digit returns for 2 years, pretty high single-digit returns last year, if not double-digit again. And then this year, bonds are doing well also. bonds, if you think of bonds as just a loan, when you loan somebody money, what do you expect from that? Interest payments, and then at the end of the loan, you get what? Your principal back.
Mm-hmm.
That's what you should expect out of bonds.
Okay.
And I think it's important that we keep that in mind because, you tend to get a short-term memory, and the last couple of years have been very good. So we're trying just to set expectations for our clients going forward that bonds are going to return to probably more typical types of returns, which is just paying you interest, and at the end of the loan, paying the money back.
So let's talk about interest. Give us an example of what a rate would be on today's bonds.
Yeah, so the different again, when you're loaning somebody money, if you were gonna issue two loans, let's say you had $100,000 and you were going to loan $50,000 to two different people, would the rate that you give to a person who has a credit score of 750 be the same as the rate that you give to a person with a credit score of 500?
Ooh, let me answer that one.
Yeah, please do.
Heck no.
Heck no, right?
Okay.
And so you would give a lower interest rate to the person with the higher credit score.
Okay.
So in the bond world, if you are looking for something with a higher interest rate, you're probably going to be taking on more principal risk for that interest that you're getting, right? Because there's more of a risk that the principal won't be paid back if you have an entity that is more risky. Does that make sense?
Yeah.
Yeah. So that's all that it is. So, but like for instance, right now you can loan our federal government.
Whoa.
Yeah.
Whoa.
Do I look like China? Sorry.
You don't.
I knew you were going there. I really did.
Good call, though.
Ralph Lauren, that's me. Sorry, I can't help it.
Yeah, no, but anyway, if you wanted to, you can loan them money for 10 years at a whopping rate of about 1.5%. Okay? You could loan the country of China, speaking of China, you could loan them money for 10 years at a rate of probably closer to 5 or 6.
Nice.
You could loan Greece money for 10 years right now at a rate of like 30%.
Do they pay it back in euros?
Yeah, we don't know yet. That's the question, yeah.
That's a very good point because we don't know if they're.
We don't know what the future holds.
Actually, we really believe they're going to pay it back in farm animals if they pay it back at all. If you don't end up in their bankruptcy.
Because we don't have enough.
Right.
No,
so the riskier the entity, the riskier it is of you, the proposition of you getting your principal back and you getting those interest payments, the higher interest you're going to charge.
Okay, so
this is really great stuff, Kate. Seriously.
So it's simple, but I think that because bonds are packaged in all these different products, mutual funds, exchange traded funds, you see them in closed-end funds, you don't actually see, unless you're buying the individual bonds, you don't actually see the bonds that are in there, and all you think is like, well, this is paying me this, but you don't actually really understand like what's going on behind it to pay you that. What is creating that?
Right, and we talked about that before. Don't invest in something you don't understand.
Exactly.
And if people are out there buying bonds and they don't know what they're really truly putting money towards, I think that could be a little dangerous.
It can be dangerous, and in fact, I was just in a meeting this last week, and we were laughing about the fact that risk is only an issue after the fact, and it's usually only an issue when someone's taken too much. Yeah,
right.
Exactly. So you just taking a risk is not a bad thing, but you need to look at the potential reward from taking that risk, and you need to understand what those risks are. With bonds, a big risk that people are looking at right now is interest rate risk. If interest rates go up, the price of the bond can go down. And I can explain how that works if you want. I mean, if we want to go into bond math. Again, I love bonds, so I don't know.
Let's talk about some of the other stuff that we have. Increments, incremental amounts. You said $50,000. I personally, I don't have that in my pocket to be sharing with any government of China or the U.S.
Right.
So tell us incrementally.
Okay.
For the common consumer, how much do you have to spend to buy a bond?
So if you're going to buy an individual bond, which is you pick out one specific entity, it can be a corporation, it can be the state, it can be the federal government, what have you. Bonds are issued at par of $1,000.
Okay.
Typically, if you're going to buy a bond, though, you want to buy lots of like 5, 10, 15, because they become easier to sell if you need to sell them early. That's beyond the scope of this conversation, but just so you know.
Sure.
The nice thing about the financial industry, there's not a lot that's nice said about our industry these days.
I was going to leave that alone.
Yeah, thank you. The mutual funds. A lot of the times you can go into a very diversified bond mutual fund for $250. Sometimes the minimums are that much. And you can get, and sometimes those portfolios will hold 100 bonds or more, and you're getting diversification across a certain space. So like a mutual fund is nothing more than investors pooling their money together. The manager goes out and says, I'm going to buy X, Y, and Z bonds and put them all in the portfolio. You guys all get to share in the returns.
Wow.
That's what a mutual fund is.
That's
whether it owns
fund.
stocks or bonds or whatever it owns. You can also buy exchange-traded funds, which are index funds. Very similar to mutual funds in that it's a grouping of certain securities.
But you're not going to have the same ability to watch the growth of the particulars as you do when you purchase individually.
Correct. And here's the issue, and here is the main difference that you have to understand if you're buying a portfolio of bonds, not versus an individual bond. With an individual bond, just as with a loan, when you go to loan a person money, you say, I'm going to loan this money to you for 5 years, let's say. And at the end of 5 years, you're going to pay me interest along the way, and at the end of 5 years, I get all the principal back, right? It doesn't matter what happens to interest rates during that period of time, really, because you're going to get your interest payments and you're going to get your principal back, and then you get to decide whatever you want to do with your principal at that point in time. With a mutual fund or an exchange-traded fund, there is no maturity date. There is no point in time in which you get your principal back and you get to revisit that initial decision. So if you are holding a mutual fund and interest rates double, triple, quadruple, you're going to see the price of your fund drop, and then you have to make the decision, do I hang on to it and keep collecting the income? Are the managers going to at some point in time be able to catch up with the rise in interest rates, or do I sell it when the price is possibly depressed?
So which do you recommend? Or is there not one way to say it?
No, I think I don't really think there's one way to say it. I think for either more risk-averse investors, I think the individual bonds are nice because you can actually see it. The only thing about that is you own one entity. So if you picked wrong and that entity goes bankrupt, it is a bigger risk. So they can be safer, but then they can also have more risk.
Sure.
But the nice thing about the individual bonds, again, is they've got the maturity date. You know exactly what your interest payment is going to be. From the day that you buy it, you know exactly what your return is going to be, provided you don't sell it early. With the mutual funds, right now especially, there is a potential to make quite a bit more in a fund type or, in a managed product than there are in individual bonds. I mean, I go to our bond inventory, and it's a big, huge list, and I say, I want to buy a bond that's 3 to 4 years out, let's say right now. In high-quality corporations, maybe 1%.
Wow.
And a lot of investors they're not happy with that. So what do you do? Well, then you have to look at, what other products are going to be in the same realm but pay you more? So mutual funds then and index funds are a nice way to supplement your income. We actually like a mix.
Okay.
When you're buying individual bonds, typically you need to have a little more capital. You got to have more money because you need the diversification. If you've got a large sum of money, then you can get diversification with the individual bonds. They're typically less expensive to own because there are no internal charges like there are in mutual funds or exchange-traded funds. So that's a nice thing for cost-conscious investors. But if you don't have a large amount of capital or you don't want the singular risk, if you don't have a lot of money, you don't want to put, again, all your eggs in one basket, like Craig said, I like the mutual fund approach. That being said, even with mutual funds, you want to have different types of bonds. You don't want to put all your money into one particular type of bond. You can get a lot of benefit from diversifying within the bond sector.
You made a comment earlier, and you said a bond that was 3 years out. 3 years out in terms of maturity, as far as that particular bond's concerned.
Correct.
So at the end of that,
you're loaning the money for 3 years.
So that 3-year term, at the end of that time, you've received your interest rate return. You're going to receive your principal back at that time.
You got it.
Gotcha.
You got it.
Gotcha.
Yeah.
And because I'm kind of a patriotic girl, I'm going to ask this question. I really am, because I think in this day and age, in this economy, we have definitely gone international with everything we look at, everything we read.
Global.
Yes,
global.
Everything's global because of the internet and whatnot.
Yeah.
Is it not true that investing in bonds in this country would benefit our economic condition currently? Yes or no? If there's no true answer, it's okay. I'm just curious because
I say no.
Okay.
Because here's the thing: when our Treasury goes to borrow money, as you joked earlier, who's buying it? It's not us.
Okay.
Or it is more now. It's been our Fed. Our Fed is buying our own Treasuries bonds, so take that.
No, but honestly, because
but no, I mean,
because there were times when you bought when we did rations in the wars and you bought war bonds, and I mean,
Right.
there was a lot of patriotism that was behind all of those movements. So when we talk about bonds, it takes me back to my grandparents and parents and their stories.
I think that's a little bit of it, like old school way of I mean, yes, I think it's at one point in time that probably was the case, but the bond market is a multi-trillion dollar market. I think it trumps the size of the stock market by 4 times.
Wow.
So when I said it makes the world go round, because if you think about it, companies, for instance, big companies, they actually borrow money overnight. Mm-hmm. They have overnight borrowing, and that a lot of the time like funds their needs. They may have short-term borrowing to fund inventories and that kind of thing. Mm-hmm. Countries do the same thing. Mm-hmm. So to go back to 2008, the reason actually that the market really started down after Lehman Brothers went under is because they cleared, I believe, like about a quarter of the world's bond trades, which means that all of a sudden all these bonds like didn't have a home, and that's how the credit markets froze, and that's what really drove the equity markets down. It wasn't a stock market issue. Yeah, it was caused by the housing market, but that again, those loans were sold as bonds.
Wow.
Mispriced and misrepresented.
In a bad way.
In a very bad way. Yeah, absolutely. But so I think it's important, bonds or loans, it's a huge part of the market. Mm-hmm. I think that people just don't totally understand exactly how they work and exactly how they're supposed to work. So again, we've been setting expectations with our clients saying, you're probably just going to collect income, but bonds are there to be the safe part of your portfolio. They're designed to be kind of the static, steady income. Let the stock market be more of your, longer term money, your riskier, your capital that's at risk. Bonds, you really don't want that. And so I think especially right now with rates being as low as they are and the potential for them to go up at some point in time, I think it's a big deal. You need to be having a conversation with your advisor about this, especially if you're retired.
Right.
So it seems to me this particular realm has evolved to the degree, just as the banking institution said, it used to be you went to the local bank, you talked to your local guy who loaned you local money, and it's
and even
it's
going
back
to the talk about commodities, the fact that commodities are a global product. If you're China and you've got to buy oil from the U.S., you have to exchange your yuan or your renminbi, however you say it, into dollars. Well, that's currency, but that also kind of factors into the bond market as well. So, I mean, bonds and the currency market, which are very closely tied together, it's a huge issue.
No wonder you like this.
Right? Fascinating.
Now you see what
it makes the world go round, these
now
bonds.
You know what I see in bonds.
Yeah.
Right? Bottom line is
so
don't let your portfolio leave home without them.
Yeah, no kidding.
Right?
Yeah, I think so. And I think, age has something to do with it. Typically, the older you get, the more you want to be in safer things. I think you have the word safe anymore. You got to take with a little bit of a grain of salt. Know what you own. Yeah, exactly. But even for people who are more risk averse, they don't want to take a lot of risk in the portfolio, and they're willing to accept lower returns. Bonds can also be a big part, of a younger person's portfolio in that regard. If there's something you're going to need money for in a couple years, college, a car, a house. Bonds, especially individual bonds, are a great way to prepare for that because you can buy a bond that has an ending date that corresponds with the starting date of the money that you're going to need. So, I mean, it's a good. They do really help plan.
Plan accordingly.
Exactly.
Right.
Yeah, exactly. And again, with what our team does, I mean, we kind of look at like a 3-tiered approach, and it's like you want to have one tier, you want to have like cash emergency savings, money that if you lost your job or you had a big cash outflow need, money would be there. The second tier is going to be for anything that you're going to need in the next couple of years. Bonds fit so well in that second tier, if that makes sense. Because, again, they can be designed to be short-term in nature. They should be a little bit safer. So you can really kind of manage your liabilities. You can manage your risk with that second tier. And then if you've got extra money after that, if all your needs are satisfied in those first 2 tiers, then the third tier, go wild. Put some risk in your portfolio. Own some good equities. You can make them dividend-paying equities if you prefer income. If you don't and you're okay with just relying on growth, you can do that in a third tier. But again, that's where the financial planning comes into play. And that's why we pound the table so hard on financial planning. It's because we can't really tell you just based on your age. That is really an old school approach, is saying, well, you're 50 years old, so you should have X amount in stocks and X amount in bonds. No way.
It doesn't work.
No way. It's needs-based. And if you don't do a plan, you really don't know what that need is for bonds or for equities.
You may have once, but you're definitely going to have needs. And it's important to sit down with a professional to make sure that you get all of those out on the table. If you've got questions for Kate, give her a call. Kate Eiland, UBS Financial Services, 248-4097. Again, that's 248-4097. If you have any real estate or mortgage questions, give us a call. We'd love to hear from you. 800-979-3958. You can also check out our resources online and listen to past shows from the Real Estate Radio Network on YouTube by going to our website at reofresnohomes.com. To friend us on Facebook, use Press 4 keyword.
Friend Valleywide on Facebook.
Or use Press 4 keywords.
KMJ, call Valleywide.
To call us anytime. We want to hear from you. We really do. Michelle wants to hear from you.
I do.
Michelle especially.
I'm so excited. Please call me.
Coming up, short sale. Tired of hearing about it? Well, I tell you what, we're going to talk about short sales, and we're going to add a little different twist to the computation of does it make sense to stay or go? Make sure you stay with us. You're listening to the Real Estate Radio Network here on 105.9, the FM KMJ.
This program is brought to you by the Real Estate Radio Network. Visit realestateradio.us for more info. That's realestateradio.us.
Thinking about buying a home? Find out how the HUD Home Store can help you. Visit HUDHomestore.com. Look at HUD homes available for sale near you or nationwide. Why HUD Home Store? HUD will pay up to 3% of the buyer's closing cost. The price of the home is based on an FHA as-is appraisal, which is already completed, saving you an average of $400. And there is an owner-occupant priority bidding period during the first 30 days. Want to know more? Visit HUDHomestore.com.
All it takes is one call to the professionals at Valleywide Homes, and you'll start building wealth in real estate. Whether you're looking for your first home, moving up, or your next income-producing investment property, let the experts at Valleywide Homes help. There's never been a better time to get into the real estate market. Visit our website at reofresnohomes.com or call toll-free 800-979-3958. That's 800-979-3958. And put the seasoned professionals of Valleywide Homes to work for you.
Real Estate Radio Network with local expert Craig Barton. Now, here's Craig.
Well, we said we were going to talk about short sales. Let's kind of take a look at this, and I was going to say a global approach, but it's not really that global, but it's pretty huge when you're talking about anyone that owns real estate in the United States, but primarily here in California. If you purchased a home somewhere between the years of 2005 and 2010, or even then, maybe you refinanced during those years, you pulled some cash out, you put in a pool, you pulled some money out for your kids for college, you might be upside down. And why is it so important to continue to have this conversation? Well, again, Michelle, as you had said, making a decision or not making a decision is still making a decision.
Absolutely.
Where are you at? What do you need to do? Are you really suffering from analysis paralysis? And it's a serious, serious topic. And the important thing, again, we continue to preach week after week here on the show that our job is to really get you the timely and accurate truth. You may not have listened to that show 6 weeks back or 12 weeks back that we talked about short sales. You may be terrified. You may be terrified to make the call. You may be terrified to ask the question. It might be something that is pride-related, meaning that you feel like, I failed. And I'm telling you, I'm speaking to a lot of people out there. I speak to so many people on a daily basis that they do feel like they have failed. Their intent was noble. Their motivation was noble as well. The unfortunate thing is when you get clipped by the front wheel of that 18-wheeler, when the market goes the way it did after the end of 2006, there was really nothing that anyone could do. There's such great momentum to the crash site, and I use that all the time. There was only enough jet fuel on the plane to get us to the crash site. It was inevitable. Unfortunately, too many folks had access to financing that they maybe shouldn't have had access too. And also subsequently, maybe too many folks made decisions that they may have, or maybe they should have been a little more conservative on. So many folks made decisions just for the simple fact that they said, hey, I don't want to get left behind. If I'm going to own a home, I'm going to buy now. Never thinking that the market would turn in such a serious manner.
The values could drop.
Exactly.
Well, and my industry certainly didn't help. I mean, it's financial engineering is great until it's not.
Yeah, exactly.
Like you said, until it's an issue.
Until it's an issue.
I find it interesting too. I'm coming across folks who, because of their feeling of ethics, and they feel like their moral character is tarnished if they look at short sale.
Right.
And
very common.
Very much.
Absolutely.
So outside of the failure piece, they also feel like they are.
There's a moral and ethical obligation to follow through on that obligation.
And I'm not pastoral in any way. I'm not a priest. But what I would say is, in this situation, the banks have already been paid by the government for a lot of the things that they're trying to repair now through short sales and foreclosure and principal reduction. So I think that that's something you need to consider. If you didn't go into this with the plan to, take money from someone, trust me, they've been reimbursed.
Well, and I don't think people are short selling their houses as like a punitive measure on the banks.
No.
I mean, you're doing it.
But
chances are you're doing it because it's a personal financial decision. As we were saying for the show, you've got to look at, what's done is done. And you can't go back and change it. Period.
Correct.
So what you have to look at from here on out is what makes the best sense for you and your family and you and your family's financial future. And if staying in the home doesn't make sense versus short selling it, then I think it's something you have to consider. Because, 10, 15 years down the road, if you've made the wrong decision and you're strapped or, it's going to be a bigger issue then than it is now, more than likely. Yeah,
and Michelle, you bring up a really good point. I am not addressing this as to whether it is a moral issue or not. I am looking, really, the intent is to look at the mechanics of the situation and say, so where are we at today? And I'll use an example here. We've got a home appreciation calculator. It's a simple Microsoft Excel spreadsheet. We're actually working on the website as we speak. At some point, you as a listener will be able to go to our website and plug in this information for yourself and get feedback as to, given these variables and some typical, what we might find in a normal market, typical appreciation, to see really truly where are you going to be at in X years. Well, this particular scenario was from one of our listeners. Their current mortgage balance was $178,492, so almost $180,000. They estimate their current home value, and here's the hard part. Estimating what your home is really truly worth. Sometimes that you really do need a professional to help, because you might say, well, this one down the street and this one down the street.
Right, it's a moving target.
Exactly. And we do this every single day. Again, we're not appraisers. I spoke with an appraiser this morning. Appraisers are to be respected, and we are humbled by their knowledge and their expertise. Let me just say that. And appraisers are our friends. Estimating value, we'll give you a ballpark. We'll give you a ballpark plus or minus 3% as to, based upon the last 90 days and a deviation somewhere between 200 and 300 square feet plus or minus, comparing apples to apples. What's the market done in your neighborhood? Estimated home value of $125,000. If we saw annual average appreciation at 2.5%, it would take you just to break even between 14 and 15 years. Now, again, our disclaimer is that annual appreciation is just an average and just an estimate. And it also does not take into consideration principal reduction. If you are paying down this mortgage, granted, if you have an interest-only loan, then this example is pretty right on for you. And again, the current estimate of value is just that. It's just an estimate. So if your current mortgage balance is $179, let's say, and your estimated home value is $125, at 2.5% annual appreciation, it would take you between 14 and 15 years just to break even. For your home value to get back up to your mortgage. So that your mortgage,
even
just flush.
And even if you considered principal reduction, you may be looking at 12, 13.
It might shorten it.
Yeah, it doesn't shorten it that much. Yeah.
And depending upon how much you're going to throw at principal, it can help, most definitely. And we can calculate those numbers for you based upon the current terms of your mortgage. Now, let's say, just what if you got out of the market today, if you made the decision, to short sale your home today, and your mortgage had been delinquent in the last 12 months, you'd have to sit out of the market, typically on average, roughly about 3 years. Hopefully it'd give you the opportunity to save some down payment as far as a down payment is concerned.
Cure credit.
Cure credit if there were issues as far as your credit's concerned. Really, that time is so valuable because 3 years helps you to plan not to fail. You don't go into it saying, I'm going to sell my home, and then 3 years from now, I'm going to take a look at my credit, my income, and see where I'm at. Absolutely, positively,
do that along
not
the way.
Exactly. You've got to do it. There's got to be, annual checkups in terms of where am I at, where am I headed, what do I need to do to get where I need to go.
Well, and again, this is designing your plan, your roadmap for
Most
success.
definitely. Most definitely. So if you decided to exit the market, meaning you sold today, and let's say you were looking at a house that would fit you and your family, given your current needs, that was priced roughly about $150,000. We're going to make some assumptions. If it's priced at $150,000 today, well, what's it going to be worth in 3 years? Because some folks say, well, I don't want to sell now because in 3 years they're going to be so much worth so much more. Do you know at 2.5% appreciation over the next 3 years, in 3 years that house for $150 is going to be worth $157,593. That's all. Now again, plus or minus. It could be more,
Right.
It could be less, given the amenities, the location of your home, school district, etc. So you got back in and you bought that house that was worth $150 today, and you picked it up for say $160. Well, another 11 years down the road, that house at 2.5% appreciation, average appreciation, that house would be worth $211,946. So what you're looking at is, if you view it as failure, if you view it as just a financial decision to make that move today, in 11 years, or you sit out of the market for 3, in 15 years in total, you'd have roughly about $50,000 in equity just by making that move today.
Versus flatline.
Versus 15 years and just being even
So
and staying where you're at.
So the same 15 years.
Yeah, the calculator is nice, I think, because it takes the emotion out of it. Obviously, there's going to be emotion. When you're talking about selling your home, whether it's a short sale or not, there's always emotions. But especially if you feel the moral obligation
There's a
that you're
gamut of
somehow
emotions.
shirking your responsibilities.
Yep.
Absolutely. But this is good because then it puts the numbers right in front of you. Then you can add the emotion back into it and see if the numbers, still
Right,
make a difference.
if you can
to
justify
you.
it in your mind.
Yeah, absolutely.
Sure.
But it's nice to have this information so that you can make some kind of a calculated decision
Right.
as opposed to just guessing.
Do you know how many folks that echo exactly what you said, Kate, is that when they've seen the spreadsheet and said, I never knew, A, what to do or who to talk to,
Right.
but even take it a step further, maybe they had spoken with someone and didn't break it down in this fashion and make some assumptions. Again, plus or minus. Could be, maybe, I don't know. But utilizing just, lukewarm appreciation at 2.5%.
Right, yeah, 2.5% is light, yeah.
And granted, we can adjust it.
Yeah.
But when the day's done, not making a decision is still making a
Still
decision.
making a decision.
And that's the hard part. What I was going to say as far as emotions concerned, I've seen the gamut. But I can say this, for a lot of folks, and they've sat in my office and broken down in tears, the moment that they feel, the moment that they let go and say, it's time,
But they feel better.
they feel like the weight of the world's been lifted
Absolutely.
off their shoulders.
Well, if their house has become a financial burden, I think there's a difference. Some of the short sale activity I feel like has become a moral hazard, and that people who really can afford their houses, they're just mad that the property is down in value, and that I feel like is a totally different scenario than is somebody who maybe they lost an income in the household or their wages were cut in some way and they can't afford the house. There was a divorce, there was a birth. There's all kinds of things that could happen that could make your mortgage then unaffordable. And for those people, I think that this is particularly powerful.
Right. If you'd like us to share this home appreciation spreadsheet or worksheet with you, give us a call anytime on our off-air number at 800-979-3958. We'd love to share it with you. We'll email it to you if you ask. And at some point, we'll have the website up and running so that you can actually punch these numbers in yourself and see exactly what we're talking about. Bottom line is, short sale is not to be taken lightly, but trust that we'll get you the answers. And then the ball is in your court as to whether it makes dollars and cents for you to do it now, in hopes that you can help position yourself better in the future for you as well as your family. What we're going to do now is we're going to take a look at some listener questions, and I brought this one specifically for Michelle.
Thanks. Thanks, Greg.
Colleen from
Is it
Fresno.
a really hard one?
No. I just know I know it's her passion. Colleen from Fresno says, "I've been with the same agent for a year. Shouldn't I have found a home by now?"
Okay,
come on
she
now.
wasn't talking about me being her
No,
agent.
this wasn't.
I want to make that clear.
No, this was not Colleen, your client.
Right.
Yeah.
I've been,
A
my
question
client.
from a listener.
yes,
I really-
from a
yeah,
listener.
okay.
Should I get a new agent?
No, not necessarily. What is the agent doing? Are you communicating regularly? Are you out looking at properties? Are you a client? Are you somebody that they are truly attempting with everything they have to meet your needs? Are they available to take you to showings? Are they talking you through offers? I mean, really,
Bottom line, in
truly.
today's market,
Are they
a lot of
educating you?
agents are working extremely hard. I would just say this: if there's 11 offers on that property, there's 10 losers. Remember
exactly.
Yeah,
that.
Again, if you have any real estate or mortgage related questions, or you have any questions regarding the information that we're sharing with you here on the show, call us anytime, 800-979-3958. We'd love to hear from you, or use press forward keyword KMJ, call Valleywide to get connected to us anytime. A big thank you to Kate Eiland from UBS
Absolutely.
Financial Services. Kate,
Always
as
a
always,
pleasure.
great job. If you'd like to speak with Kate, 248-4097. Again, 248-4097. A big thank you to my right-hand gal, Michelle Pettiscavalli.
I'm still wondering why that one question was thrown out.
What do you mean?
What question?
All right, because
All right.
clients
I don't know.
continue to call us on our listings and ask that
Yeah,
question. Okay, I just
exactly.
was like, okay, I felt like it was hanging. I wanted to make
No,
sure people knew that
it wasn't hanging.
that was why we brought it up.
Thank you, Michelle. I appreciate
Sorry.
that. A big special
I'm all about clarity.
A big thank you to Johnny B behind the mic. Johnny, you make us sound so doggone good. Again, remember, it is our goal at the Real Estate Radio Network to get you, our listeners, the timely and accurate truth about your local real estate market so we can help bring you back home. Don't forget to tune into the Real Estate Radio Network next Sunday at 7 a.m. right here on 105.9, the FM KMJ. Make it a great day, Central Valley, and we will see you right here next week.
The preceding program was paid for by the Real Estate Radio Network.